Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. And today's topic is this new rule that has been talked about by many tax professionals, that has been talked about by the government for a number of years, and finally it's coming into full force starting this year, 2023. And your deadline, the first deadline to hit is essentially March 31st, 2024. Now, why is it important? Because this new reporting rule requires anytime Canadians own anything in trust for another person, you would need to do a trust return filing. And why is it important to you? Why may it affect you? Like, for example, if you add someone, your elderly parents, add your name to their bank account to help them arrange certain affairs, and if the intention is that you don't own the asset, if you're really only being added to the accounts for the purpose of managing the affairs for them, there could potentially be a trust relationship happening. If your parents add your name to the property that they own to also handle all these other stuff for them, and that could potentially be some sort of a trust reporting requirement exposure. So this can potentially apply to many people and not just real estate investor. And that's the reason why we are focusing today's video on this particular topic. But before I get started, make sure that you hit the subscribe button and also give us a thumbs up if you find it useful. Share this video with your friends and families for those of you who are interested in knowing more and understand the nuances of this new rule. Now with that, let's get started. Now, so what is this new reporting requirement? Essentially, you are filing a trust return. So when you are owning properties in trust for another person, in Canada, there is two types of ownership, like in a very granular level. Very high level speaking, there are two types of ownership. The first type is called legal ownership. The second type is called beneficial ownership. So you could be on the legal title for your property. Someone else could be the true beneficial owner of the same property. So these two things could be completely different. And so when the government mentioned that, okay, we want to gather all this information to understand who are the trusts, who are the legal title owner, and who are the beneficial owner, this is what this new reporting requirement is trying to catch. This particular rule will apply to bare trust. Bare trust meaning that the legal owners on title that are different from whoever that's really reporting the income and expenses, assets and liabilities. So those two do not equal to each other, the legal ownership and the entities that are reporting the income and expenses, assets and liabilities are different. That potentially would have a bare trust relationship. Any Canadian residence trust, any trust essentially that are currently not required to file. So currently there are a lot of family trusts that if they do not receive any income, do not have any expenses, do not have any distribution during the year, they are not required to file a T3 trust return. And with this new law coming into effect, they would all be required to file a T3 trust return. Now, so bare trust, and then all Canadian trust returns that have essentially have no activities so are required, and then also the non-resident trusts that are considered Canadian trusts, and that would also be required for filing. So essentially all these trusts are required to submit an information return even if you have no tax to pay. It's not just a real estate investor thing. This whole reporting, it goes way beyond real estate. As a matter of fact, if you use a regular example, like I mentioned in the introduction, if you own a bank account, which in my case, with my mom, we co-own a joint account together, is the joint account subject to this trust reporting requirement? It really goes back to your original intention. So for example, the money in the joint account that I have with my mom, the intention is that I own it for my mom, in trust for my mom. I don't touch the money. It's my mom's money, it's my mom's rental income and expenses, assets and liabilities, so it has nothing to do with me. So I really am there because my mom usually doesn't live in Canada, so I handle all the affairs of this account for her. And under this type of relationship, I would have a trust reporting requirement. Now, but because fortunately the bank account is under $50,000 and there is a small exception that we're going to go into detail in a little bit, then from that angle, I'm exempted from having that reporting filing requirement. But if you co-own jointly own an account together with your elderly parents or in trust for your minor children, and you are owning them and the account is big, account balance is big, you might have a filing obligation. And the filing obligation could trigger a penalty if you do not file it on time. Now, if you own also, as another example, if you own a cryptocurrency account, a wallet in trust for someone else that is also under reporting requirement, you also need to report it. If you own a property in trust for your relatives in the non-resident relatives, then that is also fall under the same requirement. Now, it does, there are exceptions to the rule. The rule would not apply to trust that whole asset not exceeding $50,000 in total fair market value throughout the entire year, where the assets are only held in cash, government debt obligation, shares in public exchange, share of mutual fund corporation, mutual fund trust unit, and interest in a related segregated fund. So let me just dumb it down to simple layman's term. Essentially, if you have a bank account and this bank account own cash or like publicly traded stocks or government debt, then and the balance, the fair market value of the account during the entire year. So at any given point in time, if it is over 50, it wouldn't count. So during the entire year, the entire balance has to be under $50,000, then you do not have the filing obligation. So in back to my mom and our joint account example, the balance is under $20,000 the entire year, and therefore I don't have any filing obligation. Had this account balance over $50,000, even if it is cash, I would still have a filing obligation. I have to file a trust return, even though I don't have any tax to pay, but the government just wanted to gather the information, want to get to know what's happening. Now, it's worthwhile also noting if the trust was set up 3 months before the year end, so it has been in existence for less than 3 months, there is an exception. You do not need to file the return. So that is a good exception as well. Now, if you own private company shares in an account, you own it in trust for private company shares, and it is the value of the private company shares is less than $50,000, you still have the filing obligation because the underlying asset is not publicly traded companies or cash or bonds. And if you own gold and silver and Bitcoin and all these things, it does not fall under the exception. Sorry, you still have filing obligation. If you happen to own a property, like a piece of land that's like $30,000 somewhere up north, you still have filing obligation, unfortunately. You own it in trust for someone. If you own it in trust for someone, then you have the filing obligation. So these are the common example and exceptions. Now, why does it relate to real estate investors and how does it relate to real estate investors? We actually have this deep dive in the past in terms of what forms a trust. A lot of real estate investors out there are owning properties in trust for someone else. So typical real estate joint venture, you would have a corporation set up and the corporation would be going on title because the true owners are two different entities coming together to buy a piece of land. They would set up this corporation called Bear Trustee Corporation. So this company would be only in existence to go on title on the land registry as the owner. But in reality, it is the two parties, say party A and party B, they are really the true owner of that particular property. It happens all the time. This type of relationship is called Bear Trust relationship. And in this particular scenario, the Bear Trustee company would be filing a trust return. And now it has an added T3 filing that it has to comply with. Now, as another example, a lot of individual real estate investors, they would buy properties in their own personal name, and then they would buy it and form a corporation, and then buy these properties in trust for their corporation that they own, because it's easier for them to get financing in their personal name. And as a result of that, there is a bare trustee agreement being signed by between the individual and also the corporation. And as soon as you have that bare trustee agreement signed, you have a trust exists in existence, and therefore you have this T3 trust reporting filing obligation that you have to do. As another example, which I mentioned briefly earlier, is that it's not as obvious, which is the one case when you buy the property and you partner up with someone to buy the property. You're the one that qualifies for financing and put up the down payment, and the other party is responsible for growing, managing, and everything else, the operation. So you guys join forces together, but you're the only one that's on title. But the reporting, you guys may or may not have the filing, may or may not have a joint venture agreement signed, may or may not have a bare trust agreement signed. But because you are the legal owner, but then the reporting entity is you as well as your partner, the reporting entity is different from the legal ownership. There is some sort of a trust relationship happen, and therefore this whole new reporting rule applies to you, unfortunately. Now, as another common example, it's husband and wife. It happens a lot of the time. The husband, let's say the husband is the breadwinner, it goes on title, buy an investment property. Somehow, somewhere along the way, the accountant says that, well, your wife is not making money. In my example, the wife is the lower income spouse, not making as much money, and therefore the accountant suggested, why don't you just report everything in the wife's name? And so all of a sudden, the husband is on title, but the wife is reporting everything. There is a trust relationship happening. And again, trust return would have to be filed. Now, so these are all the common examples that could apply to the real estate investors. Another example would be you're on title for your parents' property, help them manage all the property stuff, and you don't actually own the property yourself, and your parents are the one that's the true owner of the property. Again, they are living there, they are having the benefit, they pay everything. You are really just there to being added to on title, just so that you can help them with calling the government, calling these people to arrange certain things, and have the legal rights to arrange the property, pre-authorized debit, and all these things. And this is some sort of a trust relationship as well, because now you are on title and your parents are on title. You're owning the property in trust for your parents. So these are all these nuances. These are all the examples that you may be exposed to, and all of these will be captured under the new trust reporting rule, and you have to file essentially a trust return. Last example, this is totally unrelated. As I mentioned earlier, if you own a bank account in trust for your child, and if it is over 50,000, or if it is not invested in the cash or stock market, those are also captured. Now, when do this trust reporting apply? Well, it actually applies for the full year. It's applicable for the year ending December 31st, 2023 and onwards. So what it means is that if you own a property during this particular year, anytime during this particular year, there's a trust relationship, and then you have the filing obligation, unless your trust is set up just 3 months before the year end. When is the filing deadline? Well, the filing deadline is March 31st, 2024. And I do believe it falls under the weekend, and it would be the following day if it falls under the weekend. And typically it's 3 months after, 90 days after the taxation year end. So whatever that day would fall under. Typically for individuals, taxpayer, their year end is December 31st, and therefore 3 months, 90 days after year end, typically falls under March 30th or 31st. So if it is a weekend, again, or a holiday, it would fall under the following business day. Now, if your corporation has a different year end, again, the deadline would be 90 days after the taxation year end. So you may wonder, what are the penalties for non-filer? Well, if you know that you must file and you're not filing and they can prove that, or they just deem that you know, you ought to know, then the following penalty could be applied. It would be the higher of $2,500 or 5% of the highest fair market value of the property that's held in the trust. So if you own a property in trust for a corporation, say that's worth $1 million, the highest penalty for non-filing is $50,000. 5% of $1 million, $50,000. So that's really, really, really bad. But you may wonder, do you need to pay tax if you file? Well, the truth is, majority of the time we're acting as the bare trustee. So the underlying property that are really owned by the beneficial owners, and the beneficial owners should always be reporting the income and expenses to begin with. They've already paid the tax. They just need you to report essentially the relationship to the government. Technically speaking and generally speaking, you would have no tax to pay under this new reporting rule. However, there's always exception and always that 5% to 10% that are different. So make sure that you consult with an accountant, professional accountant that understand your situation and understand these new law and advise you accordingly. Now make sure you don't miss this deadline because you will have a huge penalty. You could be paying on a huge penalty as well. Now that wraps up everything about this particular new law. If you like our channel, make sure you give us a thumbs up and hit the subscribe button to stay on top of the latest tax tip. Until next time, happy Canadian real estate investing.